Let's touch base with Ritu Arora now, who's the CIO of Canara HSBC OBC Life Insurance, joining us with her perspective on the market. Ritu, it's great to have you on the show and good day to have you essentially. How would you characterize what has happened in the market today where, a leading in sector, that is in IT, has been impacted severely while the overall momentum of the market still is pretty much range bound?
Thanks for having me. IT sector does look a little worrying, though we were anticipating global demand weakening, but today has been a little disappointing, and that does set stage for the results of other IT companies that will be coming. Having said that, while the demand outlook is weak, the positive in favor of this sector is going to be the currency, given the current account deficit and FII flows, which is likely to continue to be weak and depreciate further, which would be a positive. And hence the rupee numbers could be protected for the IT companies. Of course, it's worrying that the revenues from banking exposures of these IT companies look stressed. So I would not write off IT sector completely. Given the environment, it could also be a hedge to the other compared to the other sectors, which will be that much more under pressure because of macroeconomic headwinds.
But what would you do, Ritu? I mean, would you look to buy some of these stocks if they correct another 5%, or would you stay away from this theme right now?
I don't think it's a time to add weight, but at the same time, there is no reason to sell in a hurry, I would think. Like I said, depreciating rupee is another reality, as real as the bad performance of IT companies, and which is, as we all know, very positive. And it's a large sector which benefits from depreciating rupee. So I would maintain a underweight stance, but I would not run away from the sector in a hurry. But I don't think it's time to add weights either. It's just watch for a little while longer.
There is some opinion, Ritu, in the market that if TCS also disappoints, then that would be confirmed indication that the sector is going in for another re-rating on the downside for the next 6 to 8 months, or from a medium-term perspective. Do you subscribe to that view?
I would definitely, like I said, want to watch the sector. TCS, if it is also gives a tepid result, it would be definitely worrying. But it's not completely surprising because the fact that global economy has not been growing at a very fast pace, there have been pressures on IT company in terms of revenue and order book, has been known to us. It's just the extent and the sharpness which surprised. And like I said, one should not discount depreciating rupee, because then the rupee converted revenues would still look all right, and it is going to be a range-bound volatile market with fewer plays, and hence relatively IT would have a place in the portfolio.
Come back to some of the mid-cap names, and I essentially want your view on aviation. And what do you do here? I mean, I'm guessing as a hardcore fundamental analyst, not too many people would want to bet on aviation because of various factors like ROE or ROC. But broadly, because of the tactical reason of some decisions coming in, and maybe the stocks have already factored in, do you believe this is a sector which merits a look at purely by virtue of the correction that's happened and some announcements probably around the corner?
I agree with you when you said that it doesn't really excite a fundamental person to look at aviation at this point in time, because it is a sector which is largely driven by news and speculation at this point in time. There are inputs that have been coming in and out, and that has caused huge corrections and even rallies in these stocks. We saw huge stocks having an upside today. So it is really not a sector that one would comment on from fundamental point of view at this time. Once there's more clarity that emerges is when you can evaluate it on its fundamental strength and have an opinion.
The other two sectors, where also there's been much debate, on from a valuation perspective, as well as where the fundamentals add up, given the scores of issues that these sectors come into, are real estate and infrastructure. What would be your approach right now in terms of stock picking from these sectors? Or would there be a complete avoid, especially real estate?
For me, at this time, both these sectors are an avoid. Of course, there's a cash crunch that both these sectors are facing. There's no uptick in investment cycle. A rate cut would be a positive sentimental move which could have a positive impact on these sectors, but the problems are a little deep-rooted. Policy action is needed as much as a rate cut is. And since we don't see much traction on that front, I would keep away from both these sectors at this point in time. If I had to play rate sensitives, I would rather play private sector banks than infrastructure or real estate.
Is the motivation for private sector banks essentially the fact that, given the market's expectation that there could perhaps be a 25 basis point cut, there is of course likely to be a favorable impact on NIMs for private sector banks vis-a-vis public sector banks?
I agree, and I do hope and expect that there would be a 25 basis point cut in the rates on Tuesday, because that is really essential for one, changing the sentiments in the economy, and two, for investments to pick up. It is concerning to see capital formation falling the way it has been. So for me, that is more worrying than IIP numbers or even inflation numbers, because that will plague the economy for a very long time.
So would you accumulate some of the large private sector banks at these levels?
They have actually had sideways movement, and I have always had a fair exposure to private sector banks. I've always recommended that. I prefer them to the PSU brethren because of the better management that they have and better control on their NIMs. And it might not be, tactically I would not advise doing it just in anticipation of rate cut, but from a long-term whole point of view, they make a lot of sense. They still are at attractive valuations, and we look at it from long-term investment, and we like it very much.